Greetings everyone, Jake Bernstein here, Weekly Capital Markets Report. Trading lesson for Sunday, June 30th, 2019 at 6:41 a.m. in Santa Cruz, California. Many of you have heard me talk about the moving average channel, 5 consecutive bar pattern. However, apparently there's still some confusion about how to use it, so let me show it to you in detail. We have here on the chart the usual moving average channel. In red, 10 bars of the high moving average. In green, 8 bars of the low moving average at the bottom of the screen. The blue line, Williams accumulation distribution. The red line, a 57, that's 5-7, simple period moving average of the Williams accumulation distribution. The typical buy trigger, 2 consecutive bars above the top of the channel with Williams above its moving average. Buy trigger, 2 bars. However, sometimes a move will begin with 5 or more consecutive bars above the top of the channel. In this case, we've marked the 5, which turns into 6, which turns into 7. The more consecutive bars we have above the top of the channel, or conversely, in a sell trigger below the bottom of the channel, the stronger in the first case, or the weaker in the second case, the market will be. The 5-bar pattern is very significant at the beginning of a move. So how do we use it? The buy trigger occurs at the end of the 5th bar, which would be right over here. You can either buy it at the end of the 5th bar or buy it at the beginning of the 6th bar. However you do it, you calculate the profit target and the stop from the range of the 5 bars. Let me get the dollar difference tool and show you. Here's the dollar difference tool. I drag the tool from the top to the bottom. Let me show that to you. Here's the highest high during the 5 bars. And we take that from the highest high to the lowest low. So it'll be from here to here. And this is very approximate. We can adjust that to make it correct. The high of this move has been, let's take a look, 1348.90. So let's adjust the line to 1348.90 and make it exact. 1348.90, like so. And now we have the exact move. This range is your first profit target, is calculated from the close of trading the 5th bar. It is also your stop. You say that stop is too big for you, then don't take the trade, or wait for an opportunity to buy at the bottom of the channel. In this case, it never came. If the stop is too big for you, you can trade a mini contract, a micro contract, you can trade an option, many different alternatives. That does not change the fact that this is a very strong pattern and usually reaches its profit target fairly quickly. So let's take this move right over here, the 55.60, and move it from here and calculate the target. Let me show you what I mean. Come on, computer. Let's do it manually. Very difficult to manipulate this tool. There are either easier ways to do it, but let's try it again. Just want to make sure you get the point. There we go. So right over here, the first target is reached. So let's put that in. At that point, you have several choices. If you're using my money management methods, you take some money off the table, you hold some of the position, but in any event, you reduce your risk effectively to 0. Let me put that back on there, please. As you can see, it takes a little bit of skill. And by the way, this can be programmed automatically. I think we have actually programmed it. And if you want to find out about that, you can go to jakestradingstrategies.com. Okay, target hit right over here. The second target is equal to the range of the first target, which would be another 55.60 to the upside over there. So that would be the second target. In terms of stop, once you've hit your first target, you're home free. If you have multiple positions, you liquidate part of the position and hold some of the position. The initial stop is the same as the target, which would be down here somewhere. If you want the conservative stop, it's an in-the-market stop. If you want the aggressive stop, which means you could lose more money if you're wrong, but you stay in the position longer, make it a close-only stop. Let's take a look at another one. Now on the downside. By the way, if you did not attend my mid-year forecast yesterday, it was a great webinar. You can still order it and get the recording. So let's go to the next market. Opposite position, opposite situation. And that would be the... Hold on, let me get that for you. Natural gas. So here's natural gas September contract. And let's look at it. Moment, please. Here's the 5-bar pattern in the opposite direction. In fact, let's do it this way. Let's do it this way. Here you go. 2-bar pattern right over here. Williams accumulation distribution below its moving average. It's a sell trigger. We measure the range of the 5 bars. The entry would be to go short at the close of the last bar, which would be right over here. And let's measure the range. And many times these moves will be very big, so you can find alternative methods for doing this trade that require less risk and less exposure. So let's get the dollar difference tool. By the way, I hope you're enjoying these lessons. If you have questions or you have any suggestions, jake@trade-futures.com. Let's get the dollar difference tool now, like so. And as I say, we have these marked on the trading software that Chris Moody has done at jakestradingstrategies.com. Let's go from here to here. Decent sized move. And you can see that we achieved that target. I'll try and do better with this one. Which took us very close to the low of the move. You enter a trailing stop and take money off the table, etc. So I hope you enjoyed these lessons. Give me your feedback. I'm Jake@trade-futures.com. Best of trading to you. And I hope you learned something from me.